Traders War Room proudly presents the daily video with the best trading and investing alerts anywhere on any platform. With up-to-date stock, chart, and market news, TWR is simply your one-stop shop. Saturday Tech Video. It's Mayday, and you know how we like to rock it. 33% discount for the All Access Pass. Link is in the description. Join today and quit wasting that money that's not making money. With earnings season kind of wrapping up and just having some great big catalysts that push the market, I want to talk about stock earnings and EPS. So I want you to understand what they are, what they tell us, what they mean, and how to read these so that we can go out there and make some money every time that we get the earnings call. Understanding that you can't do much in the market without understanding earnings. Everybody from a CEO to a research analyst is obsessed with this often quoted number. But what exactly does it represent? And why does it attract so much attention? Well, that's what I'm going to attempt to break down and put it Barney style for you. All right, so what are earnings, right? Well, company earnings are quite simply its profits. Take a company revenue from selling something, subtract all the costs that it takes to produce that product, and there you go, you have the earnings. Now, of course, the details and accounting get a lot more complicated, but earnings are always referring to how much money a company makes minus its operating costs. Its many synonyms cause part of the confusion associated with the earnings, but all these common terms, top line, bottom line, net, gross, income, profit, loss, all that crap, all means the same thing, earnings. So why do we care so much about the earnings? Well, we care about earnings because they ultimately drive stock price action. Strong earnings generally result in the stock price moving up and vice versa. Sometimes a company with a rocketing stock price might not be making much money, but the rising price means that investors are hoping that the company will be profitable in the future. Basically, sentiment or projection of what it can do. And of course, there are no guarantees that the company will fulfill its investors' current expectations, but that's why we love it. The dot-com era and the bust is a perfect example of why company earnings come in significantly with the investor sentiment, right? So the dot-com bust, this example, earnings came significantly short of the number investors imagined. So they thought the stuff was just going to keep going up forever. And then the dot-com bust is what drove the prices down. When the bottom started, everybody got excited. When the boom started, everyone was excited about the prospects of the companies involved and the internet, and then the stock prices soared, right? But over time, it became clear that the dot-coms weren't going to make nearly as much money as the investors had predicted. The boom wasn't going to produce the bang, essentially, and it simply wasn't possible for the market to support these companies' high valuations without any earnings and poor earnings as well. As a result, stock prices of all these favorite dot-com companies just absolutely just tanked, and we're seeing that now with the tech boom that we've seen and these tech companies that keep getting these huge value propositions, and eventually the idea is that it's going to come up to some significant point and then their values just aren't going to be supported and will come to another dump. Now, when a company is making money, it has two options, right? The first option, it can improve its products and develop new ones. And the second option, it can pass the money on to shareholders in the form of a dividend or a share buyback. In the first case, you trust the management to reinvest profits in hopes of making more profits in the long run. In the second case, you get your money right away in the form of a dividend or share buybacks, right? Typically, smaller companies attempt to create shareholder value by reinvesting profits, while more mature companies pay out dividends. Neither method is nor better or worse, and they both have their pros and cons. And at the same idea, the long run earnings provide a return on shareholders' investments. Now we're getting into what the earnings reports are. So what is an earning report? Well, when you invest in the stock market, you're investing in a portion of a publicly traded company. In order to be a publicly traded company, a business must file both quarterly and annual financial statements to the Securities and Exchange Commission, or the SEC. Now, this particular form is called a 10Q, or that is what they file with the SEC, and an earnings report is what publicly traded companies outline their performance for the quarter or the annual statement. If you hear that sizzling, don't worry about it. That's just me barbecuing. It's the weekend thing. I'm enjoying my weekend just like you should be, but we still got some knowledge to push out. So when we're talking about earnings power, what is earning power really? Well, it shows how the company has done financially and legally, which should give you a good indication of its economic health. Put more simply, it lets you know if the company is making money, and that's what we want, companies that make money. This helps you decide when to invest, how much to invest, and whether or not you should invest at all. And things that aren't making money necessarily doesn't mean not to invest, but they're what's called speculative in nature. When you read the earnings report, you often see three parts. The first part is a press release with a few photographs on how the economy has fared over the last quarter. To make these earnings more consumable for the investors, companies transform their 10Qs into press release, and they share significant parts of the earnings report. Some information in a press release, which includes the revenue, net income, dividends, and earnings per share. And here you'll also find the management discussion surrounding holistic financial conditions. Another part of the report is in the presentation deck, and that outlines the most positive financial data for the company during the quarter. Usually, this presentation is more of a marketing ploy to tell people, hey, this is what we've done good, highlight the things that they've done good, and this is why you should invest with us. Now, finally, we just talked about it briefly a second ago. There's the 10Q. Now, this is the deep down, long and dirty, where it shows all the zero fluff version of the company's financial data over the last quarter. In the 10Q, you'll find the income statement, balance sheet, cash flow statement, and any market risks the company may be facing. It is illegal for companies to fake numbers, but that does not say that there's instances where it happens. However, it is illegal for them to do it. So revisions come usually when there's some sort of issue with the company. In most cases, the 10Q portion of the earnings report is the most telling section as it contains zero marketing bias. Now, if you're currently investing in a publicly traded company or planning to get into a publicly traded company, you should always take the press release and presentation deck of an earnings report with a grain of salt. They're valuable informations that you definitely want to read, but they are marketing material developed to promote investments. If you want the zero fluffed part of the economic health, then you go straight to the 10Q. Now, when do companies report? Well, publicly traded companies report their earnings to the SEC and investors every 3 months or every quarter. Not every company has to report at the same time, though many submit during what's commonly referred to as earnings season. And this occurs in the end part of the following months: March, June, September, and December. Now, earnings season, that's what gets a lot of people's juices flowing, okay? So earnings season is the Wall Street equivalent of a school report card. It happens 4 times per year. Publicly traded companies in the U.S. are required by law to report their financial results on a quarterly basis. Most companies follow the calendar year for reporting, but they do have options of reporting based off their own physical calendars. Although it's important to remember that investors look at all financial results, you might have guessed that earnings, or the EPS, are the most important numbers released during earnings season, and they attract the most attention and the most media coverage. Now, before earnings reports come out, stock analysts issue earning estimates, an estimate of the number they think the earnings will hit. Research firms then compile these forecasts into the consensus earning estimates, and when a company beats the estimate, this is called a beat, and the stock usually moves higher. If the company releases earnings below these estimates, it is said to be a miss, and the price typically goes lower. Sometimes you'll get the earnings surprise or disappointment, and that goes positively or negatively against the street's estimates. Now, this is the stuff that traders love, and that's why earnings season is so popular, okay? You can get dramatic shifts or binary type of movements based off of any of these results. but the most dramatics come from surprises and disappointments. All of this makes it hard to guess how a stock will move during earnings season. It's all about expectations, and that's why typically a lot of trades during the earnings seasons are considered lottos. Now, how do we read earnings reports? Well, once a company submits their earnings report to the SEC then publishes them on the EDGAR platform on their website. Use the search bar to find a specific company or document, and here are the most important parts of an earnings report that you'll probably be paying attention to. So, this is probably the most important part of it, the income statement. How much money did the company make within the last quarter? This is often noted in relation to one or more previous quarters, and within an income statement, you also find a few specific aspects. Revenue, aka sales, and you may hear this as the top line. Cost of revenue, cost of sales, and this is the total cost of the good or service sold. Operating expenses, and these are the fees involved with running a business. Earnings, aka profits, net income, or bottom line, basically all the money the company made after accounting for the expenses. And oftentimes companies experience a loss during a quarter. In that case, you'll see the monetary value in parentheses and earnings per share. This puts a company's earnings into perspective for investors. To get this number, a company divides their earnings by the number of outstanding shares, and the resulting value reflects the earnings and what it will look like if this was evenly spread out across the company's shareholders. Now, I want to break down earnings per share a little bit. To compare the earnings of different companies, investors and analysts often utilize the ratio earnings per share, or EPS. To calculate the EPS, you got to take the earnings left over for shareholders and divide them by the number of shares outstanding. You can think of EPS as a per capita way of describing earnings. Because every company has a different number of shares owned by the public, comparing only companies' earnings figures does not indicate how much money each company made for each of its shareholders. For example, let's take two companies, ABC Corp and XYZ Corp. They both have earnings of $1 million, but ABC Corp has 1 million shares outstanding, while XYZ Corp only has 100,000 shares outstanding. ABC Corp has an EPS of $1 per share for 1 million per 1 million shares, while XYZ Corp has the EPS of $10 per share, 1 million divided by 100,000 shares. Another part that's important, but we're not going to really dive into this because this could be an entire segment on itself, is the balance sheet. And basically, the balance sheet is a company's assets and liabilities, also what they own versus what they don't own, and a financial statement that reports a company's assets, liabilities, and shareholders' equity at a specific point in time, aka the earnings report. Another part of the report is cash flow statement, and this is a financial statement that aggregates a company's cash flow inflows and outflows from operating, investing, and financing over a set period of time. And this is where you'll see how much money a company exchanges with others. Now, another big one that people really get into is the statement of shareholder equity. And what's the value of the company's outstanding shares? What's the potential dividend payment that the company will make? In other words, what's the change in interest for the shareholders over the last quarter? To get a fuller picture of a company's financial standing, you will compare its most recent earnings report to the previous one. And you can go even further by pitting the earnings report against earning expectations to see if a company is on track according to their strategic business plan. And they usually outline their business plan. And as we've seen in recent earnings, forward guidance is really key on whether the stock specifically in this current market is getting investor sentiment to the bull side or to the bear side. Now, how do these earning calls work? Well, numbers alone don't always tell the whole story, and that's where the earnings call come into play. Earnings calls are web or phone conferences led by publicly traded companies to discuss the earnings report. They're beneficial for investors because they meaningfully put the data into context. At the same time, they provide guidance for the future investor and answer questions people may have surrounding the report. Now, typically, companies will utilize a press release to share upcoming earnings calls, which tend to take place shortly after their earnings report is published. Attendees typically include the investors and the stock market analysts, and because of the current technology that we have with social media and stuff, a lot of the brokers are now allowing the retail investors to listen in on these calls, and you can usually click links straight from your broker. Now, here's a basic agenda for the earnings call. To start the meeting, an investor relations officer will deliver a liability limiting statement in the event that actual members differ from those in the call. Then the CEO or another executive discusses the financial results. Sometimes it'll be the CFO. Finally, the company gives way to question and answering session for participants to actually take part in and to ask the questions that the shareholders typically are wanting to know. Now, upcoming earnings report calls, in order to understand this, to learn about those and when they come out, you can always go to the NASDAQ earning calendar. The site showcases company calls on a daily basis, and these calls occur Monday through Friday, and they take place either pre-market or after hours, sometimes during the market, but that's usually for specific information that the company wants to put out. Within a public app, members can view upcoming earnings call dates for specific companies and even set calendar events to be reminded in advance. And once you find a company that you want to attend, search that company, look for the press related information, and find the link and dial into the number. All right, now listen, that was a down and dirty. There's still a lot more to cover, but I think you guys got the basics of it. Earning calls can feel daunting given the volume of information that they contain. Breaking them down into their key components, the 10Q, the press release, and the presentation materials can help you unpack the data that's being shared. While the press release and presentation might be illuminating in terms of a company's marketing approach, the strategic part that investors should really pay close attention to is that 10Q, because that is the bare bones, no BS. What did the company do this particular earnings report? Earnings ultimately are a measure of the money that a company makes, and often related in terms of earnings per share, which in my opinion is the most important indicator of a company's financial health. Earnings reports are released 4 times per year and are followed very closely by the street. In the end, growing earnings are a good indication that a company is on the right path to providing solid returns for investors. So now you know, and knowing is half the battle, and I'm just trying to provide you that ammo for your weapon so that you can go out there and destroy the market. And as always, I hope you found value and worth in this, and I will definitely catch you on the next one, and let's go to war together. The market is our war zone, and stocks are the battle. Join TWR and let's go to war.